Welcome to T3 Live's Options Market Situation Report. Matthew Buckley, the Chief Option Strategist here at T3 Live. And obviously, market's still under pressure today from the ECB keeping rates unchanged. Mario Draghi's press conference was more or less a non-event and just shows how addicted to quantitative easing that the markets have become. That we kind of have this temper tantrum. It's crazy. August factory orders came out today and absolutely imploded. It plunged by the most on record. We were looking for, look at this, last month was 10.5% positive. Now, the consensus was a big negative, and we actually blew that big negative out of the water. I mean, that's absolutely crazy. Challenger job cuts weren't that bad, relatively good news, along with weekly unemployment claims, but this factory orders number is just nuts. So we, for all the, bulls out there, everything's great. Corporate profits are great. Everything's great. The macroeconomic data coming out this week aren't supporting that thesis. Add that to the fact that now there might be an Ebola case in Hawaii, that the case in Dallas was just completely fumbled. A guy comes in with a fever, says he's flown from Liberia, and they send him home. I mean, our country's really prepared for this. So there's a lot of volatility going on in the market. But with options traders, we can potentially hedge against that. Here's an SDS bullish double vertical that we placed Tuesday in our primary live trade brief. That's up $3,200, a 262% gain since Tuesday, and it's Thursday. But obviously, that's a bilge pump. That's not necessarily going to keep your entire portfolio hedged. As you can see, there's a dark green, there's some light greens, there's some pinks, and there's some serious reds here, especially my EWJ positions as the Nikkei got slammed based on us getting slammed. So it's great to have hedges in your portfolio because you can potentially profit on a downturn in the market. But again, know that a lot of my longs are getting kicked in the gut as well. However, that's why they're called longs. A lot of positions in my portfolio go out to 2016, and the 2017s are starting to come off the assembly line there. That's a good thing. Okay, so we use hedges to hedge the front month volatility, and if our longs get kicked in the gut, that's fine. Especially since these longs are a lot of long call diagonals, where, for example, on days like today or the past couple days, where we can roll down our short calls. We use an opportunity. This is great. Our short calls profit. We take some profit or roll them down. So great, I'm not too worried about the overall model portfolio positions, especially now that we have some hedges here and we're taking some profits on. That's why these are called longs. Okay, so let there be no doubt. There's a lot of blood in some of our model portfolios on the option side of the house, but the bilge pumps are working as advertised. Okay, and keep in mind, folks, you can't always fully be hedged, right? I mean, you can't wrap your kid in bubble wrap and stick him in his room and hope he never gets hurt and never let him outside. I mean, if you don't take any risk, there's no reward, obviously. So we always got to take a little bit of risk, but we can hedge the front month, potentially make some money as our longs get kicked in the gut and hopefully recover here, because I think we're oversold at this point. Okay. All right, folks. Happy hunting. Make sure you hedge. I'll be back with our Friday's market wrap up tomorrow. We'll see you.